Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I am Darshan Mehta. Let's welcome our experts on the show. Joining us today are Sharmila Joshi, who is an independent investment advisor, and Sangeet Lakkar of Newberry Capital. Thank you to both of my guests for joining in. On the show today, we talk about the FMCG space, where most of the stocks that have come out with results have actually shown subdued volume growth. And is that indicating a consumption slowdown? We ask our analysts whether the high valuations that this space commands is justified. We also analyze Federal Bank's fourth quarter earnings and whether it warrants a buy at current levels. Numbers were decent, asset quality managed to improve, and the counter is up almost 4% in trade. Most of the IT stocks corrected on Friday significantly. Cognizant cut its FY20 guidance to the lowest in over 2 decades. We discussed with our analyst whether it's a concern for the Indian IT industry because most of our stocks also corrected. And lastly, we discussed the struggling ADAG group companies and whether any of them are worth your money at this juncture. Most of them have corrected 70, 80, 90%. But for the long-term investment, should any stock from the ADAG group be bought or should they totally be avoided? So that's something that we will discuss in Hot Money today. Let's start with the first space, and that is the FMCG space. Now, most of the companies that came out with numbers has disappointed, be it, a Godrej Consumer or Dabur or even the big one that was HUL. Britannia was a disappointment, but Britannia, what aggravated concern was the intercorporate deposits that happened. So overall, most of the companies did manage to disappoint. What's the view on the sector going ahead? And are valuations now starting to look much more expensive? And are they justified? That's something that we will ask. Sangeet, host of FMCG consumer-facing companies have come out with numbers. So a lot of them are out, so you can get a fair idea. And none of them have surprised. In fact, some of them were in line. Some of them did manage to disappoint severely. Volume growth didn't come in. Are valuations now? Will people start looking at valuations more closely, whether this is justified or no?
I hope they do, and I have been very cautious in this space since last 12 months or so, and we had spoken about it earlier also early this year, that I correlate this situation very similar to what happened in US in the early 70s, where in the McDonald's of the world, the Coca-Colas were trading at 80 times earnings, whereas the broader market was trading at about 18, 19 times. What happened post that after 5 years was there was a severe value correction in all these consumer names to the extent of 50 to 70%. I'm not sure whether something similar would happen in India, but definitely I don't see a value re-rating from here on. There will be a long time correction is what is my guess. And I remain very cautious on this sector.
Anything in this sector that you find that valuations are decent?
Valuation wise, I don't think anything is decent at the moment, but if I have to pick amongst the consumer names, I would go with Page Industries.
Page Industries, because of the correction that has happened.
Because of the corrections also, and because of the growth and the underpenetrated market which they have. The kind of, the distribution channel which they have, people, I guess, are worried about the competition from the foreign brands coming in. But I think it's going to be very difficult for anyone to replicate the distribution channel which they have.
And you think that this pain will go on for a while, at least for the next few quarters? It's the first quarter where we've seen actual pain coming in. There was slowdown, but this is the first quarter where companies themselves are admitting, there is a slowdown. Over the next few quarters, will this continue?
I think there is more to this pain, moreover. Generally you would expect that a pre-election quarter, there would be a little rural consumption spurt. But, ignore the consumption spurt, there has been a, volume kind of a standstill. So I expect this pain to continue for some more time, and I'm more worried from the valuation standpoint at which these companies are trading.
Okay, Sharmila, you tend to agree that, were you surprised at, the numbers that started to flow out from these FMCG companies and the commentary?
Well, not surprised, but I think a definite negative because yes, as you said, somewhere you were factoring in that maybe you will not see the kind of volume growth that some of these FMCG names had reported in the earlier year. But I think the kind of numbers, for instance, that you got from Dabur was quite disappointing. I think even Godrej Consumer, for that matter. And HUL, strangely enough, in the sense I'm talking about the volume growth, was decent. It was in the sort of a band which market was talking that they would get. But I think here is where the valuation aspect comes in, because I think that all of these were trading at such fancy valuations that it becomes very difficult to therefore see a situation where people will rush in to buy these shares. Because I think this volume growth picture, which is now emerging, it seems to me that it's going to take more than a couple of quarters to sort out. Because first of all, as you all were just discussing, there is a general expectation that volume should actually pick up in a pre-election sort of a scenario that we didn't see working out. Then you're going to get into straight away monsoon, which is expected to aid sort of rural pickup. And that again, we don't know how it's going to play out. There again, reports have been very sort of diverse into what kind of a monsoon we are going to get. So I think the factor that stands in favor of FMCGs is the fact that it's a defensive sector. And because we've seen this consumption hit like more broad spread, whether it's autos and, a whole host of discretionary spends also, possibly you will see these sort of hold out better, with a slightly 9 to 12 months sort of a perspective. But yes, I think valuations definitely have to correct from here. So I think if you have the shares, hold them. But if you don't have them, don't look to enter at least for the next couple of quarters.
Okay, any of the stocks, because most of them have come out, have you told any of your clients to trim positions in any of the stocks after seeing the numbers?
No, honestly not, because I think that the recommendations have broadly been in Dabur and HUL. So there I continue to be sort of neutral to positive.
And you believe that the slowdown probably will continue for the next few quarters?
Yes, I think that's a given. The way the volume picture has emerged, it's a given that is going to be there at least for the next couple of quarters, if not more. Because I think also some sense of base effect is coming in, because they were growing for a very long period at a very good clip. So I think, there is that sense also. So yes, I think circumspect is the right word.
Okay, so I think concerns clearly there as far as the FMCG space is concerned. Most of the companies that have come out with numbers have actually come out with numbers which were in line or disappointed. The management commentary for most also was rather muted. The company which did well this time around was Federal Bank. It's up almost 4% the last time I checked. Came out with a decent set of numbers. 4.5%, came out with a decent set of numbers, came out much higher than what the street was anticipating. Asset quality was decent. The management came out with a decent quality, commentary. ROA actually above the 1% mark after almost 19 quarters. So there is improvement that we've seen even as far as the balance sheet is concerned. What do you make of Federal Bank? That's something we'll ask. Federal Bank about 100 now, almost after a year. It keeps on moving between that 80 to 100 level. What did you make of the numbers? Do you think that it deserves a buy, or should you stick to the larger private sector banks?
Well, I mean, whether you want to stick with the larger private banks is your this. But I think if you just talk about the numbers, I think they were really a really good set of numbers. And I think, in an earnings season, which has been largely, I would say, bad, this definitely was a real a pleasant surprise in that sense, because not only did the numbers look optically good, but I think even if you look a little deeper into the numbers, where the growth has come from, whether it is their auto loans or whether it is their home loans in the loan book, or whether you talk of the NPA levels, gross NPA levels actually lower, provisioning lower. So where a lot of other banks have faltered, they seem to have managed to put in a good performance. And okay, yes, you can talk of the profit number being almost double from what it was last year, but I think it's more the the drill down that market has really liked, that that has shown that they're really on a good recovery path or whatever. I mean, they're not recovery really, but they're really on a good strong growth momentum. And again, I think valuations are in their favor, because if you see the what price the stock is trading even at 101 to its book value, and what some of the other banks are trading at, then there is definitely room for further upside. So I wouldn't put it past, really. I think you can easily see the stock at, if it continues in the same way, at a 130, 150 kind of level before long. So yes, I think
any concerns that you saw in seeing the number? Was there something that you disappointed?
Well, not in the numbers, but I think in the space as a whole, because so far they definitely seem to have shown good growth on all the parameters. But like for instance, as I said, one of the good parameters that came out of this was they had good loans to autos, but we are seeing a slowdown in autos. So how does that work out in the next quarter? So those kind of concerns will be there, but I think broadly they seem to have dodged the NPA bullet, and they seem to be on a strong wicket. Okay,
what did you make of Federal Bank numbers, Sangeet?
So yeah, I mean, the numbers were healthy. I think large part of growth came from the non-interest income and lower provisioning. As a sector, I remain very positive on private sector bank as a pack because of the public to private transition what we are witnessing. And as particular to Federal Bank, I am little neutral to positive. I mean, it's not the bank where you can compare it to a HDFC or a Kotak because they are more geographically concentrated also. Their CASAs are also a little lower. They have about 31% CASAs, whereas the other private sector bank, whether Axis, Kotak or HDFC, have more than 50% of CASAs. So that's because of that the cost of borrowing is elevated for Federal, and that will continue to be elevated. They are also, they have a little legacy issues also. So they have been traditionally a slower growing bank, and that's why the valuation trades at about 1.5 times book. So I wouldn't give Federal Bank a 3 times or a 4 times book, but definitely a 15-20% upside from here is warranted.
Okay, and if someone has to take a position at this point of time, would you suggest, because it's already moved up, taking positions in Federal Bank or sticking with the larger banks?
So my pecking order would be Kotak Bank, maybe followed with something like a Bandhan Bank through Grah Finance, because that gives you a 10% discount considering the swap ratio, and then followed by maybe a Federal Bank.
Okay, that's the view that's coming in on Federal Bank. Potential long-term position play is something that can be done on the counter. Now, one concerning thing that happened on Friday was, the IT stocks did manage to correct. Counters like TCS were down almost 3.5%. And one of the key reasons for that was the Cognizant numbers that came out. And the commentary was cautious. They cut the guidance. TCS has managed to rebound, but is that a concern for the IT industry? And what's the overall view on IT? That's something that we'll ask. Sangeet, first of all, on Cognizant, is that a concern what Cognizant said? Because most of them, the street reacted very negatively to the IT stocks.
I think it's definitely a concern, and I mean, look at the quantum of guidance which they have cut out. I mean, they guided for 7.5% to 9% earlier, and now they have come back to 3.5 to 5%. Also, the large part of pain is what they have outlined is going to be in the financial services and healthcare. The majority of our IT companies, the Indian IT companies, is whether TCS or Infosys, have about 35% revenues coming from BFSI. So it's definitely a cause of concern, I would say. But I personally have a view that over the next year, the currency should depreciate. That's going to aid the IT companies. We have a prolonged period of benign inflation, which I think may not be the case going forward, and that would inch up the currency. That may aid up the IT stocks.
What's the pecking order that you've told your clients? What's your pecking order in terms of for general IT?
So among the IT companies, I like Infosys. None of the other software companies as such, but I like product companies, maybe an Excelia, Kale or some other. But Infosys is amongst the large caps.
But overall, your view on the IT sector is a little cautious at this point.
I'm a little neutral. I'm not as negative as because of the Cognizant guidance, purely because of my view on currency.
Okay, that's the view. Sharmila, was that a concern for you, what Cognizant said?
Oh yes, I think obviously, because as Sangeet was saying, it's basically the fact that they cater to the BFSI space. They are known as a big player within that, and then you have them really giving a drastic guidance cut. But I think what sort of stands in favor of the Indian IT companies is two things. One is that I think in the kind of scenario that we are in, I prefer large cap IT as a play, simply because I think it's your play against what is happening domestically as well as what is happening globally in terms of rupee depreciation, etc. So it is a defensive sector to my mind at this point in time. And which is why I've been positive, in fact, on the large cap IT, and at several points, I think even on the show, I've recommended HCL Tech, etc. So I think that's one big point in favor of IT companies. I think the second thing that sort of is seeing a little bit of a bounce in the IT stocks today is the fact that most of the large cap IT numbers are already out. So we've already had Infosys declare numbers, we already have TCS declare numbers, and we've seen that the kind of so for instance, Infosys also. Market did get a little disappointed with with their guidance, but their outlook was nowhere as negative as what Cognizant seems to have declared. So somewhere there is a sense that they are not seeing the kind of order slowdown or in their space, whichever spaces they are in. So I think that's a definite positive. And also I think their other verticals are growing. So BFSI is not the only vertical that they are in. So we have seen other verticals grow. We have seen an increase, especially the larger cap ITs. IT companies have had a larger share in the digital share of business, etc. So they are looking at other spaces, because this IT space is changing very fast. So for instance, we don't have any company in the Indian context which is only in the AI space, but all the large cap ITs are sort of dabbling in it. So I think this space is going to look very different and very interesting going ahead. It's not going to look like anything that was the model of the past. And there is, I think, effort on the large cap ITs at least to sort of keep pace or catch up. So I think with both these factors in mind, I think yes, there is definitely a big sentimental hit, and we saw that playing out. But I think going forward, it would still be the sector that I would like.
Okay, so what's the pecking order there?
As I said, HCL Tech Mahindra, TCS, Infosys.
Okay, that's anything in the mid-cap IT space that you
mid-cap IT, I've basically liked Persistent System and Zensar.
Okay, that's the view that's coming in on IT. Obviously, there seems to be a little bit of concern as far as what Cognizant did manage to pull up. And the last, actually, group that we want to talk about is the ADAG group. It's been extremely volatile. Most of the stocks have actually come off 70, 80, 90%. But is there any hope? While some of them are going through tough phase, there are some companies which actually have assets under them, which are actually doing well. But I think everything's been painted with the same brush. Are there any companies in the ADAG group that warrants a buy, at least for the long term, not an intraday trade, not a very quick term trade? But is there any group in the ADAG stock stable that actually has value? We'll ask our guest. Sharmila, anything in the ADAG that you've recommended to your clients, given the prices? Obviously, there are corporate governance concerns that are there. A lot of other external issues are there. But on pure valuations, on pure business, is there any group company in this table that you believe that can create value?
Well, honestly, I would just stay away from now because, I think there is generally not, I would like to see that clarity on how they're going to really get out of that whole RCOM situation and how they're going to pay back the debtors there and how that whole situation is going to play out. Because as you said, that maybe in the longer term, you could look at a Reliance Capital, given that, they have that insurance business, etc. to which has some kind of value within their book. They have their own investment book as well. Then you could also talk of Reliance Infra. But very honestly, at this point in time, I haven't recommended anything, and nor do I think you should buy anything as of now. So really, in one word, the answer is no.
Okay, what about you, Sangeet? Anything in the ADAG stable that looks interesting for a long-term perspective?
Yeah, again, one word answer is no. Because of the group's capital allocation policy. But having said that, I think Reliance Nippon Asset Management is an interesting stock. Prima facie, the biggest trigger for me is ADAG group has to exit that company. So you will get that company into stronger hands. Operationally also, I think it's available cheaper at about 30-35% discount to other peers. It is the largest asset management company in India in terms of retail assets. Trades at about 5% of AUM of the mutual fund business. They also showed 34% growth in their last quarter results. Having said that, it comes with a set of risk. The biggest obviously is the ADAG group attached to it. They have about 400 crores of ICD given to various ADAG group companies. In addition, various schemes, they have about 1500 crores invested through the various schemes in ADAG companies. So I don't know how that comes back to them, though the management has come out and clarified that none of them is likely to be degraded, but we'll have to see how it pans out. And also the recent regulations on capping the expense for mutual fund business, we'll have to see how that plays out. But I think if I have to choose amongst these companies, this is a relatively immune, insulated from the other group companies' distress that we're talking about.
Okay, so that's the word that's coming in on the ADAG group. RNAM probably is the only name that comes in, but overall the general trend is avoid ADAG at this point of time. Just a few open-ended questions. Sangeet, you've seen the earnings seasons that's come out. What's your sense on if you analyze the earnings season? How has the earnings season been this time around? Are you happy with the corporate results that have come out? Anything that stood out for you this time?
I think in terms of results getting stood out, I think banks, I would say Kotak banks, the likes of private sector banks, which were expected to do well, and they did do well. In terms of negatives, I think the way we started the conversation about the FMCG business, I think nobody expected such a dramatic kind of a virtual no growth volume growth for FMCG companies. That's going to be a concern. One another interesting pocket to watch out is the cement space. I think they have reported fairly good pricing power this quarter. So though a couple of larger companies are yet to report, but I think cement as a pack looks interesting.
Okay, and same to you, Sharmila. How did you find the earnings season so far?
I think bad really. And yes, I think the negative was the FMCG lot. That has clearly been disappointing. So I think the whole consumption space, autos, I think is a given. We've seen some of the numbers, and that's going to be a given. So there were definite pockets where you were already seeing concerns, and then you have a story playing out in terms of the ILFS exposure that banks have. So even if bank numbers are okay, you have that thing at the back of your mind that some of these NBFCs and banks could be having exposure to all these stressed assets. So where does that really take you from there? So all in all, it's been a very sort of a disquieting and discomforting kind of earnings season so far. So barring IT, where we started off on a fairly decent sort of a note, I think things haven't really gone quite to the script post that. So let's hope it improves, because that way this the earnings season plays out for this entire month, and so hopefully things will look better. But so far, really honestly, it's been quite bad.
Okay, just hold on. Two important earnings that will come out today. It's likely to be a subdued quarter for Bharti Airtel, at least this time around. It's India's largest telecom player. What should one expect? Somit is standing by. Somit, what can we expect this time around?
Well, overall, if you see the consolidated numbers, they're expected to be flattish, but on the India mobile business, the numbers are expected to be good. Now, for the consolidated business, if you see the revenues are expected to come in at around 20,600 crore rupees. The EBITDA of the company is expected to come in close to around 6,300. Margins are expected to expand marginally to 30.5%, while the company is expected to report a net loss of close to 1,000 crore rupees. Now, the key number for Bharti Airtel would be the average revenue per user. That is expected to come in 15% higher to close to 120 crore rupees. Now, the growth in ARPU would be primarily because of the minimum recharge plans, high 4G subscribers, further subscriber losses, and because of fewer days in the fourth quarter of financial year 2019. Now, for the India mobile business, growth is expected to be because of more data users that are expected to come in this quarter. And overall, if you see the subscriber base for the India mobile business is expected to decline to 27.6 crore. However, if the fall in subscriber base is much higher than anticipated, then optically the ARPU number would see a good growth, but overall the numbers would be still weak because of the subscriber losses that the company has been seeing. Now, the non-mobile business, they are expected to be a drag on the overall India operations. The fixed line or the broadband business and the DTH business are expected to see a quarter-on-quarter revenue decline because of competition and because of implementation of TRAI's new tariff order. On the consolidated basis, if you see, the numbers could well surprise and come ahead of the analyst estimates, but that would be because of a strong Africa performance. As against analyst expectations, the Africa business reported a good set of numbers. Africa business EBITDA grew sequentially despite a seasonally weak quarter, so that was something strong that came in, and that could aid the overall consolidated numbers for the company. Lastly, key things to watch out for from Bharti Airtel earnings would include the rate of 4G subscriber additions, their FY20 capital expenditure guidance, asset monetization plans, and any management commentary on tariff hikes would be important to watch out for from Bharti Airtel earnings today.
Okay, and the second one is ICICI Bank, and they're expected to report a sharp jump in profits in the fourth quarter. Shefali, what can we expect?
From ICICI Bank, we are factoring in a 20% growth in the net interest income to about 7192 crores and a huge jump in profits by about 124% to about 2292 crore rupees. Amongst the factors that we'll be looking forward to, we are factoring in loan growth of about 14%, which will be primarily driven by retail loans, and deposits growth of about 13%, which in turn will be driven by term deposits. And the key thing to look forward to in their earnings would be how they fare in terms of the asset quality. And so from this quarter onwards, the incremental stress addition, that is likely to go downwards, and the watch list loan is also expected to decline on a sequential basis. So the net stressed assets were about 6.8% of the loans at the end of the third quarter. So from that level, it's expected to come down. The gross NPAs, we are factoring in about 7.5% versus 7.75% on a sequential basis. Margins expected to be largely stable at about 3.4%. So net good set of earnings we're expecting from ICICI Bank this time around.
Okay, many thanks for that, Shefali. We'll certainly watch out for all those numbers. But with that, we are expected to wrap this edition of Hot Money. Many thanks to all of my guests for coming in. Sangeet, thank you so much for coming in. Sharmila, thank you so much for coming in. Ask BQ comes up next. Stay tuned to Bloomberg Quint.